Hey everybody, it's Greg Gossett from Gossett Trading and Mentoring, and today is Saturday, June 15th, 2024. Hey, how's it going? How you doing? I hope you're doing well. I appreciate you coming to my weekend review podcast. I hope it's going to be helpful for you, and the format of the podcast today is going to be as follows. First of all, we're going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to take a look at all the trades that I made last week, both on the daily time frames and on the weekly time frames. We're going to talk about when I entered the trade, why I entered the trade, what was the strategy, what were the combinations or confluences of signals that were lining up at the moment that I took the trade. We're going to talk about where I place my stops, where I go into trailing stop mode, where I'm going to take partial profits on the way up. We're going to talk about significant overhead resistance levels, but we're going to talk about how I'm going to manage the trade going forward. Once you put that trade on, you have no control over anything. But before you put the trade on, you have total control of, am I going to get in the trade, where I'm not going to get in the trade, how I'm going to position size based upon volatility, where I'm going to place my stops, where I'm going to take profits, the whole thing. It's just important in trading that you're patient and you wait for a confluence or combination of indicators or signals to happen before you enter the trade. You put the trade on, then the market's going to do what it's going to do. But the key point is that you have a good risk to reward ratio, so that if you're wrong, you can be wrong quickly and small. And if you're right, you have the potential for a large outsized gain. That's the key to profitable trading. So we'll go through all my trades. I'll show you how I'm managing the trades, what I'm looking for going forward. Okay, after that, we're going to talk a little bit about trader psychology. Always the most important skill in trading, everyone. Really and truly, I've been trading almost 29 years. The most important skill is being able to have a good plan that takes into account good risk to reward ratios, confluences of signals. But the most important thing is that you execute the trade, uh, whether you're right or whether you're wrong. Basically, following your rules. It's just amazing how we can trick ourselves into thinking this and thinking that. But really, the key is being patient with your winners and having a process that keeps you patient and in the trade if it's going your way, and just getting out quickly if you're wrong. Being impatient with your losers, being patient with your winners. That's really it. So we'll talk about a little bit about trader psychology and just some general things about good trading words of wisdom. And then I have gone through my master watch list last night, and I have gone through the list both on the daily time frame and on the weekly time frames. And I've identified some potential trades for next week on both time frames. They're not there yet. If they were there, I probably would have already taken the trade. But I think I have some good ones for next week. Definitely some companies that you'll recognize. In this market, we have this bifurcated market where, the Mag 7 are just going up nonstop, nonstop, nonstop. But the rest of the world, the rest of the stocks, the rest of the economy really is going down. When you look at the Dow stocks, when you look at some of these, big name legacy stocks that you've heard about, they're just going down and down and down. So it's really interesting to see this bifurcated market. Some stocks just nonstop up, and the majority of the stocks going down. So we'll take a look. I think there's some interesting levels here. And so, yeah, that's going to be the podcast. I hope it's going to be helpful for you. If it is helpful for you and you find something of value during the podcast today, I would appreciate if you could hit the thumbs up button. It really does help to build the channel and helps YouTube know that there's some valuable content here. So if you find something valuable, let me know by hitting the thumbs up button. Okay, so let's start with the U.S. legal disclaimer. Hang tight, and we'll get started as soon as that's over. Thank you.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, let's get started on the daily time frame positions that I have. This is Intel, and I did enter the trade on the 31st of May at $30.29. So why did I enter? Well, take a look at this green band here. Okay, you can see that here on the 16th of May, we took out this swing high. Why is that important? Well, that's important from a market structure change. Really what that means is we've changed direction. We had a low followed by a lower low followed by a market structure change to the upside. And once you have a market structure change to the upside, you generally want to buy the dips. So what is this green area here? Well, this is called a order block. This is the lowest low close before the change in market structure. So generally a decent place to buy is from beneath the low of this high to the high of this low. And so that's just the high and the low of this order block. And you can see once we change market structure, it did come back like it very often does. And so really technically anywhere inside this green area here is a legitimate place to buy using that strategy. So, yes, you could just get in as soon as it gets in here. I was a little bit more technical with it. And I did enter here when we formed a V1. A V1 consists of two bars, bar 1, bar 2. Bar 2 goes under the low of bar 1. And then as soon as it gets to the close of bar 1, at or above, that is a legitimate buy. So I did buy here at $30.29. So let's talk about the stops. Okay, so whenever I enter a trade, I position size first. The first thing I do is position size based upon volatility. How do I do that? The rule that I use is I use 1% of my total capital. So if I have $100,000, 1% of that is $1,000. I divide that by the value of the 2 ATR. That shows me how many shares to buy. So all that means is I buy that amount of shares, I enter, I place my emergency stop exactly 2 ATRs below. So if it does get down there, I have lost 1% of my account. Now, this is my absolute worst case scenario. So this is called the emergency stop. If we get down to the emergency stop, I lose 1% of my capital. In my experience, that only happens about 5% of the time. The other 95% of the time, if I have a loss, it's going to be my end of day stop. Well, my end of day stop is simply just to close below this order block here at 29.84. So you can see we have it closed below there. If it did close even 1 penny below, I would just get out. That's all there is to it. And like I said, in the worst case, if it goes all the way down to my 2 ATR stop, of course I get out there as well. So next thing, so we talked about position sizing, we talked about our emergency stop, we talked about the end of day stop on this particular strategy. You see the orange line up here. What is that? Well, the orange line is my trailing stop mode. All that means is once I enter and it gets to my trailing stop mode, and by the way, the trailing stop mode is 1.5 ATRs above my entry. So if it gets there, now I go into trailing stop mode, which all that means is if in the future I have a close below a previous bar's low, I'm going to get out of half of the position. That's all that it means. So here on the 12th, we definitely got to trailing stop mode, but you can see we haven't had a close below a previous bar's low, so I didn't take any action. Now, next thing is, we've talked about the stops and trailing stop. Going into trailing stop mode basically is a trailing stop, right? So we've talked about position size, emergency stop, end of day stop, going into trailing stop mode. These are all defensive moves. Okay, these are all defensive strategies, but as with any good sports team, you want to play offense and defense. So let's talk about playing offense. How do I play offense? I play offense by taking partial profits whenever the price moves the value of 0.45 ATRs from my entry. Right now, the 0.45 ATR value is 35 cents. So really all that means is I take my closing price, 30.45, add 35 cents to it. That is my first profit target for Monday. I take my first profit target, add the 35 cents to it again. That's my second. I take my second, add 35 cents to it again. That is my third. And how much do I get out at those profit targets? Just 10% out of however many shares I have remaining. And so it's, to me, it's extremely important to take partial profits when you have them. Not all, not everything, just a little bit. And there's some advantages to that. One, you lock in some money at a profitable price, right? That's an advantage. Two, you reduce your position size. And why is that good? Well, in reality, the lower your position size, the more likely you are to follow your process. That's really what it is. It's all about following your process. And if you have to play little tricks with yourself mentally, that's fine. And so, really, I'm a big fan of taking partial profits because you reduce your overall position size, you lock in profits the market can't take away from you. If the market does get to your trailing stop level and then, go down strongly for whatever reason, news or anything else, then you've reduced your position size. So if you do have a loss, you mitigate your loss, right? So anyway, so the day that I bought here again, we were in the bullish order block. We created a V1. I got in at 30.29. You can see I got in during the day. At the end of the day, we closed near the high. So I already took off one profit target during that day, locked it in, reduced the position size. Then we came down. On this day here, you can see I hit two profit targets. We moved sideways, we moved sideways. 3 days ago on the 12th, we gapped up very nicely and I took off more profit targets. So right now, I entered at 30.29, it's 30.45. Am I up on the trade? Yes, I am. The remaining shares, I am up not too much, only 0.53%, but really I'm up more than that because I took profits here, I took profits here, I took some profits here right at the open, right at the top. So yeah, overall, uh, oh yeah, 0.52% on the remaining shares, but overall I'm up more on the trade because of taking the partial profits. I highly recommend this for a variety of reasons, but I really think it's a good thing and I really enjoy it in my trading. So the remaining shares here on Intel up 0.52%, 53%, excuse me. And I am in trailing stop mode because I got to my trailing stop mode level. It's just that I haven't had a close below a previous bar's close. All right, so that's Intel. Oh, I guess one more thing I want to talk about Intel. Just in a general sense, we are really moving sideways here. And the important thing about moving sideways is I can guarantee you, once you start moving sideways for an extended period of time, you're going to break one way or the other. Problem is, we just don't know if it's going to be to the upside or if it's going to be to the downside. But sideways motion leads to trends. We just don't know if the trend is up or down. And it could be down. Have to keep our mind open. I mean, of course, I want to think that this is going to move sideways and then move up. Maybe probably more likely, right? Because of being in the bullish order block and so forth. But I have to keep open to the idea that it could surprise and go down. And if it does, well, I have a plan for that, right? I have a plan because if I close below the low of this order block here, 29.84, I'm simply going to get out, and that's it. But you have to have a plan, everyone. You really do. You have to have a process where you figure all this out and go out and get yourself one. If you don't have one, You know, I teach private one-on-one lessons in the evening time via Skype. I teach a 15-hour one-on-one course where I teach you everything I know, everything I use or that I have used in the last 29 years of trading. It's a great course. I've taught people from all over the world. And so, you know, if you're interested in really learning how to put all these things into action, you know, consider taking the course with me. All you have to do is email me. My email is in the link in the description. So Intel up 0.53%. Next trade, FXY. Okay, so this one's been kind of a stinker, but it hasn't hit my profit target. It hasn't hit my stop loss, so I am staying in it. I did enter FXY here at 59.24. Why? Well, um, this is what's called an abandoned baby. And if you'd like to learn more about abandoned babies, just go to my YouTube channel. Just type in abandoned babies or island reversals, and you'll see I have a video there. Island reversals, abandoned babies are some of my favorite trading approaches, my new trading approaches. You can see here I have this highlighted box. Well, and a bullish island reversals is when you gap down and the very next day you gap up, leaving this little baby here, a kind of abandoned. But the key is you gap down, you had bad news, immediately follow the next day by good news. This tends in the future, in my experience, to lead to higher prices. Not always, about 70% of the time. But the key with these abandoned babies and island reversals is, like I said, in my experience, 70% of the time, I'm going to hit my 4 ATR profit target. 30% of the time, I'm going to hit my 2 ATR loss. But if I'm hitting 4 ATR 70% of the time and hitting 2 ATR losses 30% of the time, overall, this is profitable. And this is why I like them. So I did not buy here when the abandoned baby happened. I waited for it to pull back and close the gap. And so I did enter here at 59.24. As soon as I enter this is pretty easy as far as the risk, as far as the profit or the loss. What I do is I take my entry point minus 2 ATRs, that's my stop. I take my entry point, I add 4 ATRs to the top, that's my profit. So this is kind of a set it and forget it trade. I'm either going to lose 2 ATRs or I'm going to make 4 ATRs. That's all there is to it. So you can see when I entered here at 59.24, next day it went up, and then we just moved down. I was like, oh man, I'm going to hit my 2 ATR profit target right away. Well, then there was some hope. Here, started moving up. That looked positive, got positive on the trade, and then brought it right back. A few days ago, we opened in the profit, but now we're back down here. So this particular trade is underwater 0.73%. But like I said, in my experience, over 70% of the time, I'm going to hit my 4 ATR instead of hitting my 2 ATR stop. You can see this was an example over here. We gapped down, then we gapped up. As soon as it came back and filled the gap, I got long here at about roughly $59. I placed my 2 ATR stop below, my 4 ATR profit target above. Had a couple days of being underwater on the trade, and then boom, went up, hit the 4 ATR, which is great, right? Because I can have 2 losing trades for every 1 winning trade and still break even. So this is a good example of where it worked well, but you can see my stop here is at 58.40, my profit target 60.96, and currently underwater on the trade 0.73%, but I'm staying bullish until it hits my stop down here or my profit target up here. All right, Home Depot. I talked about Home Depot last week on the podcast when I was looking at the potential trades, and I was looking down here, let's see, Friday, Thursday, Wednesday, Tuesday, Monday. Yeah, we were here when I did the podcast. Excuse me. And I was looking for potentially going down to the 300-day moving average as the location that I wanted to buy it. But on Monday, we moved up above the 200-day moving average. So we were under the 200, we closed over the 200 and very close to the 200. So this made a lot of sense for me to go, you know what? This is called the deep dip buy. This is part of my deep dip buy strategy using the 300-day moving average, the 250, or the 200-day moving average. And I decided to take this trade because there were so many confluences. The first one is we closed under over the 200. That's one. We also had a V2. Bar 1, bar 2, bar 3. Bar 2 goes under bar 1's low. Bar 3 closes above bar 1's close. So now we have two confluences, under 200, over 200, and a V2. And more importantly, or just as important, I should say, and I'm going to do a video on this soon, but I tell you, one of the strongest things I've ever discovered, I studied with Dr. Alexander Elder, and he uses the impulse system. You can see a bar is either going to be red, it's going to be blue, or it's going to be green. Basically what this means is if the bars are red, that means the trend is down, the MACD momentum is down. If the bar is blue, it means either trends up, momentum's down, or momentum's up and trends down, so it's neutral. Or you have green bar, which means that momentum's up and the trend is up. So what I've discovered over the years is, a lot of times you'll go red to green, or I'm sorry, red to blue, not that important. But if you go red to green in one bar, that means you've gone from trend down, momentum down to trend up, momentum up right away. Very similar to a abandoned baby, or the same concept as an abandoned baby or an island reversal. So that's why I took this trade. Under 200, over 200. V2, red green on the impulse bar. And on addition to that, have a good risk to reward ratio. If I bought here at 332.40, if it just simply closed back below the 200, I'm out. So I entered here 332.40, placed my emergency stop 2 ATRs below, my end of day stops closed below the 200-day moving average. Orange line up here, my 1.5 ATR trailing stop level. All that means is if I get there, if I have a close below a previous bar's low, I'm going to get out of half the trade. In addition to that, if we move the value of 0.45 ATRs from the previous bar's close, I'm going to take some profit. So I entered here 332.40. Next day moved up, did take some profits off. And then the next day it gapped way up. Well, I took 3 profit targets off on this particular day, which is great, right? So I've already locked in profits here. Next day, locked in a lot more profit targets. If I hit 3 profit targets, I mean, I took 30% of the trade off, right? Going to be very difficult at this point to have a losing trade on this, knock on wood. And I'm also at trailing stop mode, which just means that now if I have a close below previous bar's low, I'm going to get out of half. So this trade doing very, very well, up 4.22% in 4 days. So not too bad. Now, we are at a 61 RSI. So once you start getting a trade like this that's fairly extended, once I get to a 65 RSI, then if I have a close below the 5 EMA, I'm just going to exit the trade. Alternatively, if we get up to the 70 RSI and reject it, I'll sell half of my trade, half of the remaining shares that I have. And then if I get a close below a previous bar's low after rejecting the 70 RSI, then I will be completely out of trade. I know it sounds difficult. I promise you it's really, really not. But again, this is a deep dip buy, and I do teach this strategy in my one-on-one course. Obviously, we go through every single thing in the one-on-one. But I also have this course available on udemy.com in a video course that's very, very affordable. And I have sold so many of those around the world, and so if you're interested in learning this deep dip buy, we go through all the rules, everything. The Udemy link to this course is in the description of this video. So, okay, Home Depot, remaining shares up 4.22%. All right, Google. Okay, Google. This particular trade slightly down, but this is a short. Why is short? Well, you see the red band here and the blue bar here. This was the highest up close before a structure change. So we were talking about Intel having a bullish order block. This is a bearish order block. Why is it a bearish order block? Well, because we went high. We had a high, we went higher, we broke structure to the downside. So if you break structure to the downside, I short rallies. Well, so far this one has not worked, unfortunately. Um, where was my trade? Yeah, my trade here was right when we got back to the bottom of this order block. I got short here, 175.80. I placed my 2 ATR emergency stop above, and then my end of day stop is simply a close above the high of this order block at 178.10. So got short here, 175.80, moved up on me, then we moved down. Why is that important? Well, I took partial profits. And you can see it's important that I did. I took partial profits. I hit one of my profit targets here where I took off some of the position at profitable levels, which is important, right? Because now it's run back up on me. Then we move back up, we move back up. Here on Wednesday, this wasn't looking good because during the day, it was way above my stop. I mean, it started almost to get to my emergency stop, but at the end of the day, it did reverse and it closed back below my stop, which kept me in the trade. Next day, we gapped down and moved down, which was very important for me because I took off more. I did get out of some more of the position at profitable levels. Friday, we gapped down, not enough for a profit target. So I did take a couple profit targets on this already, even though overall I'm down on the trade, but I did take some profits and reduce position size at profitable levels. So this particular trade currently down 0.55%, but staying short. Tesla. Okay, whew, this was something. This is called a return to value V2. Really one of my favorite approaches. I teach this in my one-on-one course. I have been doing intraday trading videos that I try to put out every day. And I've had a lot of these return to value trades in those example videos of the day trades. And they work on any time frame, whether they're the daily time frame or the intraday time frame. But this was a really good example and a perfect setup on Tesla. This is called a return to value. Green line here, green line here, anywhere in between these green lines is considered the value zone. The strategy is that we close above the value zone. We did that. Second requirement is we come back down into the value zone. We did that. We have third requirement is we have sideways motion. We certainly have sideways motion. And when you have all three of those checked off, right? When you've satisfied all three of those requirements, then if you get a V1 or a V2 entry, that's when you get into the trade. Well, close above the value zone, into the value zone, sideways motion. Here's a V2. Bar 1, bar 2, bar 3. Bar 2 goes under the low of bar 1. Bar 3 closes above bar 1's close. I got long here, 177.10. I positioned the size correctly. I placed my emergency stop 2 ATRs below. My end of bar stop on a V1 or V2 is closed below halfway the washout bar. Here's the top, here's the bottom. Halfway here is 171.50. I placed my trailing stop level above. So on the 12th, I got long here, 177.10. Okay, next day gapped up huge, right? Gapped up huge. Got me out of 30% of this position right near the top. So that's why I like taking partial profits. Then it reversed back down. And then on Friday at the open, it gapped up again. Is that good for me? Yes, it is. It gapped up and I got out of another position at a nice profitable level. Now, the day before, I got to trailing stop level, and then on Friday, we had a close below the previous bar's low. So, what does that mean? it means I got to add half my position. For how much? For a 0.48% gain on the remaining shares. But the key is that I took 30% of this trade off at these profitable levels, even some at about 6.5% profit. So this is a perfect example of why it's so important to me anyway that I take partial profits. So I did sell half of the remaining shares position because we had a close below a previous bar's low after reaching trailing stop level for a gain of 0.48%. Okay, let's head over to UNG. UNG is natural gas. I did short natural gas on the 12th of June at 2082. If you remember from last week's podcast, I was looking for a short on natural gas in the coming week. Why? Well, back here on the 23rd of May, we got right to the 200 and failed. That's the black line. We failed. We broke market structure to the downside. So if you break market structure to the downside, I want to short a rally. Well, we certainly had the rally. By the way, red, green. Was it right? It certainly was. Like I said, I am going to do a video specifically going over the more in depth about the red green on the impulse. But that just caught my eye. Red green, yes, it went up. But anyway, we rejected the 200. We broke structure to the downside. I wanted a shorter rally. I could have shorted here on the 10th of June. I didn't because why? Well, because we touched the 200 and rejected it again, but it was quite far away from the 200. So the risk to reward on the trade wasn't good. And good thing I didn't because the next day, boom. But here on the 12th, we closed back under the 200. This makes more sense for me because the price that I shorted was at 2082 and the 200-day moving average was right above, right? So the risk to reward was better. So I got short here 2082. I placed my emergency stop 2 ATRs above. And then my end of day stop is simply going to be a close back above the 200-day moving average. I placed my 1.5 ATR trailing stop level, 1.5 ATRs below my entry. And of course, if it moves down, the value of 0.45 ATRs, I'm going to take some partial profits. So when I entered here at 2082, the next day did move down, did move the value of 0.45 ATR. So I did reduce my short position, locked in profits, reduced my overall position. And this particular trade is not at trailing stop level, but it is currently up 4.93%. So those are the dailies. Just a quick recap. Intel up 0.53%, FXY down 0.73%, Home Depot up 4.22%, Google down 0.55%, Tesla up 0.48%, and UNG up 4.93%. So let's go over to the weekly trades. These are weekly bars, and I make my trading decisions on these on Fridays because that is when the weekly bars close. So IBB, well, we have a bearish order block. This is the highest up bar close before market structure break. So I have been in this for quite a while. I got short at 136.69. When it came here, rejected the 200-day moving average. At the same time, it was in the red bearish order block. So got short 136.69, position size correctly, placed my 2 ATR stop above. My end of bar stop is simply a close above the 200. That's makes for a reasonable level. And 3 times now in the last month, we have tried to get above the 200, failed. 2 weeks ago, above the 200, closed below. This week, we went above the 200, closed below. So the market is respecting that 200 day moving average above. There's no more buyers up there. So anyway, this trade pretty much, I think, break even. Let's see. No, it's up 0.12%, which is pretty close to break even. But profitable nonetheless. In the future now, if it closes above the 200-day moving average, I'm simply going to get out of the trade. If it starts moving down, if it gets the value of 0.45 ATRs from my entry, right now it's 136.45. The value of 0.45 ATR is 210. So if it does move down anytime next week by $2.10, I'll hit one profit target. If it moves $4.20, then I'll take a second profit target. You get the idea, right? So pretty much break even, but totally legit, valid structure where you have the highest up close before breaking market structure. So getting back into that order block is legit, but the confluence here was that we also rejected the 200. So this one pretty much break even, actually up 0.12%. Meta. Well, Meta is one of those stocks that just keeps going up and up and up. I've had a lot of trades lately where I've had really good setups. All the confluences are there, but this rally with some of these Mag 7 stops not respecting anything and just keep on going up. Well, this is exactly pretty much the same trade as IBB. Here's the highest up close before we break market structure to the downside. My entry point on this was 492.96. It's in the bearish order block. It's also halfway of this big down bar here. So I got short 492.96. I have my 2 ATR emergency stop above. My end of bar stop is simply a close above these highs here at 532. Have my 1.5 ATR trailing stop level down here. But this one's just gone against me the entire time. And this particular trade currently down 2.24%. And then I did enter VIX on the weekly. Why would I do such a thing? Well, for one, VIX is at historic levels, but this is a nice confluence of signals here. Let me first show you. We've gone down and down and down and down and down on the VIX. Well, we're going lower and lower and lower and lower, but from a MACD perspective, there are no red bars whatsoever. Here we had some red bars over here in 23, but are we lower here than we are over here? We certainly are, but there are no red MACD bars. Just this means that even though we're moving down and down and down and down, what it really means is we are running out of selling momentum. And if you run out of sellers, the implication is that you're going to go back. But just because you have a double bottom bullish divergence doesn't mean that you just jump into the trade. You have to wait for a signal. Well, I got the signal on Friday. What was the signal? Well, look at the RSI level, 30.97. During the week, we were under the 30 RSI, but yet then we close back above the 30 RSI. This is a deep dip buy approach. In addition to that, we had a V1. Week before, we had a low. This week, we went below that low, closed above the close. What does that mean? Well, so far, underneath this low, there were no more sellers here. So from a MACD perspective, we're running out of downward momentum. We had an under 30, over 30, which is a deep dip buy signal, and we had a V1. And we're at 30.97, so the risk to reward is very good. So I placed my emergency stop 2 ATRs below. My end of bar stop is going to be what? It's simply going to be a close below 30 RSI because we went under 30 RSI, closed over the 30 RSI. Therefore, in the future, if we close back under the 30 RSI, it untriggers and I get out. But we're very close to 30 right now because we're 30.97. So next week, even if it moves down a little bit and closes under 30, I'm just going to get out of the trade. Here's my 1.5 ATR trailing stop level up here, 1.5 ATRs above. If it gets there, then I go into trailing stop mode. So I bought it here at 11.21. It's exactly 11.21. So, I talked about sideways motion. Well, look, over the past month or so, we have just moved sideways on the VIX. This week, we tried to go lower and reverse back up. We rejected the 30 RSI and we completed a V1. In addition to that, we have the bullish MACD here as well. So, if VIX does go up, very likely the market will go down. And that's all there is to it. But I like having this trade, good risk to reward ratio, everything lines up. All right, everybody, before we get to the potential trades for next week, let's talk a little bit about trader psychology. This is trader psychology, but in addition to that, it's also just some good trading words of wisdom. This comes from my good friend Steve Burns. Steve Burns, great guy, he's a great trader, great author. Check out his books on Amazon. And he was a mentor and a coach of mine for a couple years, years ago. But he always has good posts, good information, and you can follow him at S. Joseph Burns on Twitter. Let's see what Steve has to say to here. I'd rather be optimistic and wrong than pessimistic and right. And Elon Musk quoted this. So how does this relate to trading? This is important. You know, I've been teaching trading for many, many years, and some of my students, when I'm teaching them the deep dip buy, they say, "Ooh, bad news, and it's down, and so forth and so on." And I said, "Yeah, I mean, usually when you buy a deep dip buy, it's going to be low, right? So the headlines, if the headlines were great, the price would be much, much higher. But at some point, low becomes too low. Look back at Apple when it was very low. Look back at Google when it was very low. You know, you can see trades all the time. You're like, why didn't I buy down there? My gosh. Well, and when we go through the trades here in a minute, you'll see I have quite a few of those. But right now, they look scary. They don't look good. They look like, who would want to buy this? Well, we're getting to certain levels. We're getting to some key levels where there's a chance that that's going to be the bottom and they're going to head back up. But back to this, I'd rather be optimistic and wrong than pessimistic and right. Optimistic and wrong. I like to take dip buy trades. I like to buy when it seems like no one else is buying, because I'm optimistic about taking them, and if I'm wrong small, right? If I structure the trade correctly and position size correctly, and I have my key levels and I have my line in the sand, then if I'm wrong a little bit, which is fine. That's totally fine in trading. So I'd rather be optimistic and wrong. Optimistic, I'll take the trade. If I'm wrong small, than pessimistic and right. I'm pessimistic, I don't know, I don't think I'm going to take the trade. And then I don't take the trade, and then there's a monster rally, and I look back and go, why in the hell did I not take that trade? All the signals were there. They were all there. So sometimes if you have a really good setup and every box is getting checked as far as levels and combinations of indicators and entry triggers, like the VIX trade I just showed you. Who would want to buy VIX here? Me. Why? Because I had the signals. Double bottom, bullish divergence, V1, under 30, over 30. All right, if I'm not going to take that, if I don't take that trade, what trade am I going to take? If I'm wrong, I know what my maximum allowed loss is, and that's only going to happen 5% of the time. If I'm right, VIX could rally 20, 30%. So what I'm saying is, if your trading strategy, if everything lines up in a way, you almost cannot not take the trade. Because if it rallies, you're going to look back and go, why did I not take that trade? Everything was there, because you were being pessimistic. You're being pessimistic, and you were right, but you're not in the trade. It's fine to be optimistic and wrong, as long as you're wrong small. But, it's kind of something to think about. If everything lines up, why not take the trade? And if you're wrong, be wrong small. And if you're right, have a big gain. That's what it takes to make money in trading. So thank you very much. Thank you, Elon Musk, for that. I'd rather be optimistic and wrong than pessimistic and right. Really has a lot to do with trading. Thanks, Steve. And follow Steve over on Twitter at @SJosephBurns. All right, here we go. Like I said, this is a bifurcated market. We have Apple and Google and Nvidia, obviously. And these Max 7 stocks just going up, nothing stopping them. They keep going up and up and up. But the rest of the economy, things are going down and down and down. Interesting. We've never had a more bifurcated market in history than now. But when you have stocks like Caterpillar, Walt Disney, McDonald's, you know, I don't think these companies are going out of business, and they're coming into some important levels. They're not there yet. If they were there, I would have already bought them. Here is Caterpillar. You see, I've highlighted the green bar here. Why? Well, because look, the 200-day moving average is here. Does it mean it has to stop at the 200? No. But very likely there'll be some large financial institutions and large traders that will come in and potentially buy here at the 200. The key is that if we reject the 200, close under, close over, bounce at it, intraday rejection, it gives me a good risk to reward ratio, and it gives me a level to key off of. Over the 200, I'm in. Under the 200, I'm out. And if you position size correctly, then you already know your worst case scenario. Now, right now, Caterpillar technically triggered a valid signal on Friday, but I didn't buy it. What was the signal? Well, we're at $30.60 on the, or 30.60. It's not dollars, it's a reading, 30.60. So during the day, it did go under the 30 and close back above. In addition to that, it did reject the negative third ATR channel, which is important. So there literally were two confluences of signals there. The reason I decided not to buy this is I'm going to wait to see on Monday. If we gap up, then we've created an abandoned baby. So if we gap up, very likely I will take the trade on Monday, because under 30 over 30 rejection of the negative third ATR channel and abandoned baby would make sense. However, if we keep, but there's no double bottoms divergences here like there was on VIX and some of the other markets. So for right now, my plan for Caterpillar is if we gap up and create an abandoned baby, very possible I'll take the trade. I'll place a 2 ATR stop. I'll place a 4 ATR gain. If it continues down, then the 200-day moving average here, the black line, would make a lot of sense. So I'll just have to play this by ear on Monday. DoorDash, DASH. Okay, this one's a little bit more interesting because, look, here we have a low, deep red MACD bars. We rally, we come lower with no red MACD bars. So we have a double bottom bullish divergence in place here. That makes things stronger than Caterpillar, because Caterpillar doesn't have a double bottom bullish divergence in the recent past. Back over here, yes, but it's so long ago it doesn't hold as much importance. But here on DoorDash, really what I am looking for here is a move to the 200-day moving average. That would be an excellent risk to reward ratio on DoorDash. Conversely, we could potentially have a higher low V2 on Monday. We close below the value zone, we come into the value zone, we pull back. If I get a V1 or a V2 here, I'd have a higher low V1 or V2 in the value zone. That would also potentially get me in the trade. So a lot of these trades are maybe this or maybe that, just depending. If they go lower, yes, the 200 makes a lot of sense. If it goes higher and creates a higher low V1 or V2, I may get in there as well. And again, I teach at this point I trade about 7 different strategies, and which is good because it gives you a strategy just depending on what the market does. A lot of time I look at, just like here on DoorDash, if it goes down, I do this. If it goes up, I do this. But yeah, consider working with me and doing the one-on-one course. I will teach you everything I know, and these skills are invaluable. So DoorDash, if we create a higher low V2 on Monday, potentially get in there. If we go lower, get to the 200-day moving average, potentially take the trade there. But I like the double bottom bullish divergence big picture setup. Walt Disney. Well, look at that, everybody. Oof. Brutal. Look back here in January of 24, 200-day moving average. Was that a good place to buy at the 200? Look at this move up on Disney. Unbelievable. This is what I was talking about. I'd rather be optimistic and wrong than pessimistic and right. If you go back here in January when it went, do you think there were a lot of good headlines about Disney? Promise you they were not. If you'd followed the technicals, would it have been a good trade? Oof, I would say so, right? I took this trade. I remember. I took the under 200 over 200 trade on here. Yeah, I remember that trade. See why I have it marked or have it marked here? Yeah, I took that trade. That was made a lot of sense. Well, now look. If you look at the news on Disney, it's not going to be super great, but there's an important level coming here. The 200-day moving average. It respected it last time it was in the 200 zone. Does it mean it has to respect it this time? No, certainly not. But we're at a good risk to reward ratio. There'll probably be some buyers coming in at the 200. We're at 36.19 on the RSI. If we get down to the 200-day moving average, not only will we'll be in the low 30s, we'll have that confluence of potentially 30 RSI and 200-day moving average. If I'm not going to take that trade, if I don't take that trade, what trade am I going to take? So that's really what I'm looking for on Disney here is next week, some rejection of the 200-day moving average. We also have the negative 30 ATR channel, which even sweetens the deal. Doesn't mean it's going to be profitable, but it means it's a good structured trade. Under the 200, I'm out. Over the 200, I'm in. Pretty simple. Lift. Okay. Well, Lyft right now technically was a buy on Friday. We bounced at the 200-day moving average. I didn't take the trade. There's no divergences here to speak of. We're at a 35.15 RSI. I would rather have more confluences. Really, where I'm looking on Lyft next week, it's right in here about 13.41. Why? Well, here's the 250-day moving average. We have the negative third ATR channel. And if we get down to that level, we'll also have the 30 RSI. So we'll have a nice confluence. So this is really the area that I'm looking at next week. Again, could have taken it on Friday. It's legitimate as is. But look, I want to have as many different confluences stacking the odds in my favor. And if it doesn't get there, it just takes off. That's fine. I'll get something else. But if you ask me, ideally, Greg, where would you like to buy Lyft? Here, negative third ATR channel, 250-day moving average, 30 RSI. This is where I'm looking for. 1340, 1350, somewhere in here. That makes a lot of sense. And I'd like to see it reject the 250 because that gives me a line in the sand. Under 250, I'm out. Over 250, I'm in. Simple. McDonald's. Okay, so this one's not as clear, but what stuck out to me on McDonald's, I also have McDonald's on the weekly, but what stuck out to me on McDonald's is we are potentially forming a massive double bottom bullish divergence. Look at this low here. Look how deep the red MACD bars are here. Nice rally, gave it all the way back up. If we come back down and test this low here of 247.55, even if we come down here, we're going to have very short or non-existent MACD bars, where at this low, super big MACD bars. So if we come back down, test this low, we're going to have a massive double bottom bullish divergence. We're also going to have an ATR divergence. We'll have an RSI divergence. So look, McDonald's not going out of business. I don't think. I guess it's possible. So this is really on my shopping list here. All of these are Caterpillar, Walt Disney, because they're on sale. Stocks are one of the one things that people don't want to buy on sale. They want to pay full retail. Now, I don't want to pay full retail. I want to buy them on sale when people aren't interested in them. Hey, if this was JCPenney or Sears, it'd be another story, because then thinking, are these things even going to stay in business? But yeah, McDonald's most likely is going to stay in business. Walt Disney most likely is going to stay in business, right? So McDonald's is not yet where I want it, but if we can get down here, test this double bottom, have an under 30, over 30, something like that, that's the level that I'm looking for. But first things first, we want to test 247.40. Treasury bonds. Okay, so you see the red line up here, the red column, or not column, but the row. This is the highest close before market structure change. Here we have a 300-day moving average about 95.11. If we get up into, if we reject the 300-day moving average, I may take a short. If we get into this red area band, the bearish order block between 96.19 and 95.33, anywhere in this area, I may consider a short. My stop would simply be if it broke out to new highs. If we reject the 300-day moving average right now, which is at 95.08, I may consider taking it there because it's close to this bearish order block and it rejected the 300. Doesn't mean it just can't go zipping up, but it just means if it rejects the 300-day moving average, it gives me a good risk to reward ratio. Alternatively, if we were to gap down on Monday, we would have a bearish island reversal. And TLT is with island reversals, I'm sorry, not island reversals, but abandoned babies. TLT is very accurate with these abandoned babies and these island reversals. Let me demonstrate this to you. Bearish abandoned baby. Was it correct? It sure was. Bullish island reversal. Was it correct? It sure was. Bearish island reversal here. Was it correct? Yes, it was. Bearish island reversal here. I don't know why that's not working. Bearish island reversal here. Was it correct? Yes, it was. Bullish abandoned baby. Was it correct? Definitely. I took that trade. Bearish island reversal. Was it correct? Sure was. Bullish abandoned baby. Was it correct? Yeah. These work really well on bonds. Not all the time. So again, if we go up and reject the 300, I may consider taking the trade. If we go up and reject the order block here between 96.16 and 95.40, somewhere in here, I may consider taking a short. Monday, if we gap down and create a bearish abandoned baby here, it's not one yet. It would have to gap down below here and show that it was a gap up and a gap down, then I would consider getting short there as well. So a lot of potentials here for shorts for me on TLT, but nothing has triggered yet. Oil, USO, okay. Well, we had a nice under 30, over 30, and by the way, bullish abandoned baby right here at the bottom. It nailed it. Gap down, gapped up you go. So, and an under 30 over 30. Why didn't I take that trade, Greg? Jeez. Well, now we have broken back over the 200-day moving average. If we come back and check back at this 200-day moving average, I could consider getting long there. That's where the green box is here. But only if it comes back down, rejects the 200-day moving average, which right now is at 74.50. Basically, we're at 76 weight. May not get it, may just continue up, but if it does come back down under over 200, intraday rejection of the 200 or bounce of 200, I may consider getting long there. USO, XLE Energy, wow, look at this. Straight up, straight down. Okay, what am I looking for? Well, we did bounce at the 250-day moving average on Friday. That legitimately is a legitimate signal, but it's only one signal. I really would like to have multiple signals, right? It improves your chances. That's why I have the green box down here. Why down here? Well, we have more things going on. We have the negative third ATR channel. We would be right at the 30 RSI as well. And we have this 300-day moving average. So I'd like to, I'm interested in XLE, but for me to get into it, really ideally, and again, I have control over this until I'm in the trade. And so I just want to stack the deck in my favor, and stacking the deck in my favor would be getting a lower RSI reading, getting down to the negative third ATR channel because 92% of prices tend to hold there. And then on top of that, we have the 300-day moving average here as well. So really kind of what I'm looking for is about 86, 80, about 86, 63. All of this would happen. But it's more of a range, somewhere in this range here of the 300-day moving average, the rejection of the 30 RSI, and a rejection of that negative third ATR channel. So that's the sweet spot for me on XLE, somewhere between 87.29 to 86.41, somewhere in that box there. And then last but not least is Exxon. Well, we are getting very, very close on that level on Exxon. Look, we're at a 33.46 RSI. We're coming to the negative third ATR channel. We're coming to the 200-day moving average right in here. Boy, next week, if we reject the 200-day moving average, we reject the 30 RSI level, reject the negative third ATR channel, and close back over, most likely get long Exxon. I mean, what else? What else am I waiting for? You have the trifecta. The only thing better is if we'd have double bottom bullish MACD divergence. We don't have that, but this is the key level. So really, I'm going to be keying off of that 200-day moving average. If we can, if we bounce, close under, close over, or intraday reject at the 200, really good level for me to get into this trade. Doesn't mean it's going to work, but it's a good level. Okay, so those are the dailies, and let's get to the weeklies. And by the way, everyone, theoretically, all of these trades, both on the dailies and the weeklies, could all trigger on the same day or on the same week, on the same bar. I'm not going to take every one that triggers. I'm only going to take the best one. Even if I have 7, even if all 7 of them trigger, I'm still going to narrow it down to the best one. How do I do that? Which one has the best risk to reward ratio? Which one has the most confluences, combinations of indicators? Which one has the strongest or the weakest market relative strength? Which one looks better on the higher time frame, right? These are all the things that I use to narrow down to the best one. And again, this is what I teach in my one-on-one course too, how to do this, right? That's the devil's in the details. And you know, when you can look at 5 or 6 or 7 legitimate trades and narrow it down to the best one, you really can improve your chances. And again, that's what I teach in my one-on-one course. And again, if you want to contact me about that, my email's in the description of this video. Okay, here's Alibaba. You can see I have the green box down here. What's important about this? Well, here on the 26th, we have a low, rally, low. We broke market structure to the upside. Okay, so when you break market structures to the upside, dips should be bought. So here is the order block. The lowest close before market structure change. Technically, with this approach, anywhere in this green box is a legitimate buy area, and I'll just have to see what it does. It's not there yet, so it's irrelevant right now, but the ideal place, see the big down bar, the order block down bar, halfway of that should provide support at about 68.70. So that would be my ideal spot. If I get a V, if it rejects the top of the order block and has a V1 or a V2, I may get long there. But if I look at this and I could have, you know, if I could have my druthers about what I really want, this is the spot, 68.70. It's in a bullish order block. It's at halfway of the washout bar of this V2. So I am interested in buying Alibaba somewhere here between about 70.67 and 67.09. I know there's a lot of range there, but my ideal spot would be a rejection of 68.70. FedEx, FDX, Okay, well, 200-day moving average would make a lot of sense here. It's at 233.31. We're at 246.43. So it still has a ways to go down. Don't know if it's going to get there. Don't I have no interest in FedEx whatsoever unless it rejects this 200-day moving average. Then I consider taking it. 233.31 makes sense. GDX, gold miners, well, black line is the 200-day moving average. We broke above it, came back down, tested it. It found support. Didn't want to go below that. Then we had another nice rally up. Now we've been down for about a month. 200-day moving average is looming down there at 32.06. We're at 33.41. If we can bounce at the 200-day moving average, gives a good risk to reward ratio, or has an intra-week rejection of the 200, I may consider getting long the 200, getting long with a rejection of some type of rejection of the 200. Give me a good risk to reward ratio and give me a very definitive line in the sand. Above 200, I'm in. Below 200, I'm out. It's pretty simple. Russell 2000, okay, Russell 2000. You can see the black line here. We went below the 200, over the 200. That was the spot to buy it. It respected it. Had over a month rally up. Well, now we're coming back down to it. Doesn't mean it's going to respect it this time. Doesn't have to. But could it? Sure. So next week what I'm looking for is some kind of rejection of the 200-week moving average for potential entry. McDonald's, we talked about McDonald's on the daily. And here we are on the weekly. I love this trade on the weekly if it gets there. If we got to the 200-week moving average at 244, we would be 1 at the 200-week. 2, we'd be in the low 30s RSI, and the negative third ATR channel is down here. So, if McDonald's comes down next week, rejects that 200-week moving average, rejects the 30 RSI, very likely I would take the trade of McDonald's. How could I not? 200-week moving average giving me a great risk to reward ratio on a company that I know is not going out of business. So next week, a rejection of 244.25. I would certainly consider taking the trade of McDonald's. Pfizer. Okay, Pfizer, we had a low, we had a rally, we had a lower low, we broke structure to the upside. If I break structure to the upside, what do I want to do? I want to buy dips. Okay, well, dips here is a fair value gap. Here's bar 1, 2, 3. The low of bar, or the high of bar 1, the high of bar 1, the low of bar 3. This is called a fair value gap. And again, I teach these in my one-on-one course as well. So anywhere between about $27 and $26.17 would be a buyable area. We have the big up bar here on the third, huge up bar. Well, halfway of a big up bar, my ideal spot would be about 26.30. That would be my ideal spot to potentially get in the trade. 1, it's in a bullish fair value gap. 2, it's at halfway of a big up bar. If I bought there, my end of bar stop would simply be new lows at 24.83. Then last but not least, XLV. Okay, well, XLV, red band, what does that mean? Well, it means it's a bearish situation. Here we have our highest up close before market structure changed to the downside. What do I do if I have market structure to the downside? I short rallies, right? I short rallies. And we have rallied back up into this bearish fair value gap. Have I taken the trade yet? No. Nothing's really jumped out at me yet to take this trade. At this point, I mean, this one's pretty clear to me. At this point, if we rejected the top of the order block at 148.27, that's just the high. If we were to reject that high, close back below, that would make the most sense for me to get short there. But who knows? It might just get here. It's in the bearish order block, and it might just head down, and I miss the signal. Totally fine. But I'm in charge of what trades I decide to take. And right now, when I look at this chart, I'm just like, look, if we reject the high, I'll just get short there. If we make a new high, I'll just get out. So anyway, hopefully this was helpful for you. If you have any questions, leave them in the comment section. I'll do my best to get back to them. If you found this valuable today, I would really appreciate it if you could hit the thumbs up button. It really does help out the channel. Again, if you're interested in working with me one-on-one in my 15-hour one-on-one course where I teach you all of the different strategies, I teach you step by step. We do all sorts of simulations. And I promise you, you're going to like the course. I've taught students from all over the world, from absolute beginners all the way up to the hedge fund level. The course, or the cost of the course, is $1,750, but I promise you it's worth every penny. You're going to learn a skill that you can use the rest of your life. If you're not in a financial position to take the one-on-one course, I have a really good alternative. My Udemy course, the Deep Dip Buy course, is extremely affordable. There's 9.5 hours of video. There's 26 videos total, 15 study guides. Again, I've sold so many of those around the world and had such good reviews and feedback on those. And that's on udemy.com. The link's in the description. And I just leave you off. Most importantly, please try to go out and do something nice for somebody today. If we all did one random act of kindness to another person, the world just simply would be a better place. If you could go out and do a nice an act of kindness for an animal, they are certainly going to appreciate it. I was raised with many animals. I know they appreciate when someone's kind to them, just like we do. So if you go out and do one nice thing for a human, one nice thing for an animal, I would really, really appreciate that. And God willing, I will see you next week. But please be careful with the markets. Get yourself a process, follow the process, stick with it. And I just appreciate you being here. Thanks a lot, everyone. And on the way out here, I have to run the U.S. legal disclaimer. Have a good weekend. See ya. Bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.